everybody who over the last year got acquainted with AI being the market and the economy maybe has some trepidation around these stocks no longer being the leaders that they were. And they do represent such a big concentration of the index. There is some digestion for these large cap indices for them to pass the baton to the value, the cyclicals, the home builders, the energy. But I think overall it's a healthier market structure when you don't have just this one large cap tech leading the way. And I think that people are looking forward to, coming out of this economic slowdown. We can call it a private sector recession or whatever you want. And I think it's time to own other things.
Hey everyone, this episode is sponsored by Polkadot. Polkadot is the largest community DAO empowering 1.3 million DOT holders to shape the future of the network through active participation. With over 500 applications backed by over $6 billion in shared security, Polkadot's adaptable technology powers a diverse ecosystem from DeFi to AI. Join the Polkadot DAO and be part of that transformation. This episode is sponsored by Mantra. The Mantra chain is the purpose-built Layer 1 blockchain designed for tokenized real-world assets and regulated digital assets, offering scalable, high-performance architecture. Positioned as the blockchain for tokenized RWAs, Mantra is onboarding traditional financial institutions into Web3. Join the ongoing OM Gen Drop campaign and be part of the future of regulated digital assets today. What's going on, everybody? Welcome back to another Roundup edition of On the Margin. We've got the trifecta here back. Tyler's back. He's actually, he wasn't even gone last week, but he looks like he's back because he has a new fancy background. And now he looks like a legit trader, and there's not just children paintings in the background.
Who likes children's paintings more? I do. I think, come on.
Like, look at this guy.
Yeah.
You look like a real trader. Yeah.
Thanks, man.
Did you like decide what charts to show in the background just to pump your bags or what?
No, this is my all the macro stuff. Yeah. Zoom in on all my homes.
Yeah. It's just NVIDIA.
Yeah.
Please.
Can't tell when actually gets NVIDIA right. NVIDIA.
I know. I keep saying NVIDIA, and I've just started to own it. I know it's NVIDIA, but it just feels better, and I'm just going to be that idiot that keeps calling it NVIDIA, and I'm sorry.
Tomato.
Exactly. Yeah, we're recording this Thursday, market close, day after the NVIDIA earnings, and they came out yesterday on market close. We saw the Q2 revenue came in at $30.04 billion. Consensus estimate was $28.9 billion. EPS 0.68, estimate 0.65, and they announced a $15 billion buyback program. Digging in a little deeper on some of the financials, I think it's just crazy to step back for a second and just realize that, we've been caught up so much in the price action of NVIDIA stock, but man, like the underlying has just been insane. Like this isn't just a random pump and dump, and I feel like that sometimes gets forgotten. Like just the revenue growth in their data centers is just absolutely incredible. And, you can see in the top left, the revenue growth rate. It's been starting to come down. And, there was some guidance that came out, which is probably the biggest thing that's hitting the stock today. It's closed down just over 6%. And that really brings up an important component about, this stock really drives so much of what drives the market and the S&P 500. It is by far the biggest impact on the index level. And not only more than that is just looking at, this was something I was talking a lot about yesterday, is just how bid up implied volatility was going into earnings in the stock. And this is a really great chart from Alpha Exchange, just showing the different basically implied volatilities going into the earnings. And you can see how pretty much every quarter we've been increasing the amount of implied volatility to the point where we saw by far the largest going into this. Options are basically pricing in an 11% move, which makes it really difficult for, if you're buying options, to make money on that. This just shows the historical volatility of it. And, basically what happened is initially, we had that big crush in after hours yesterday, and then it recovered a lot of the day today. It came in at, it was chopping around like down 3%. So, if you went into this, and I have a chart here just to show, like, this is just a September 125 strike put option on NVIDIA. And I just really wanted to emphasize how hard it is to trade these things. If you bought this put yesterday, it was out of the money when you bought it. And, with the down move in NVIDIA, it would have been in the money. And you think, oh, great, I bought a put. The price went down. I probably made some money. But as you can see on market open, it's down to $6.5 on that. And, it did reverse a decent amount. And I took this earlier in the day, and we've seen the stock deteriorate further throughout the day and closed down, like I said, just above 6%. So this has reversed meaningfully, but it just shows that even if you're directionally right, this is a really hard thing to trade. Like, option markets are extremely efficient.
Yeah, one of the funniest things, if you look at the NVIDIA 1 month rolling implied volatility, I think it was down like 30%. So even if you bought a put, you probably lost money anyway.
Yeah.
Yeah. That was your whole point.
But, yeah, it's hard. I mean, like I showed like how, there's other ways you can trade this. Like, you can kind of get on the net selling side. So you're selling premium, like a call spread or something like this. This would have done a lot better since we saw the down move. But you're also you're a net seller premium. So you basically get the gain and the decrease in Vega. But yeah, it's hard, man.
I think the way, to simplify this for some of the people who are deeply in the derivatives is the house always wins. If you're in Vegas and it's a big fight, they're moving the line left and right, but at the end of the day, they end up taking the riff on, the premium. So just be careful with options. You'll lose your shirt.
I was surprised to see, I don't trade NVIDIA really, that it was such like the highest implied volatility move, and that there was so much, hoopla around it. I guess, I've trading crypto more. I've been in the dumps for the last 6 months now, so I feel the vibe shift. But there were so many signs, right? The SMCI thing, delaying their 10K, the watch parties in New York.
I was going to say the watch parties is the craziest thing I've ever seen.
And you had all these AI names report and not do that great in reactions, even if they reported okay. So it just seemed like the last, say, hurrah of this AI trade, and you saw it too with the big rotation in July and into the value and small caps, which I know we'll get into, but I don't think it's going to crash. I don't think it's .com bubble, but I do think it gives up the baton of leadership.
Yeah, I mean the earnings are real. It's just the thing's priced for perfection, and that can make for a little formula where the stock just kind of trots around and maybe bleeds lower as the realized fundamentals catch up. But yeah, it's that story of a fantastic company, like we saw in the financials earlier. Like it's amazing what it's doing. This is real. It's just everybody knows that and wants in on it, and now we're a bit overpriced.
Yeah, the hardest part about this for me is another 50 billion in buybacks, which you fast forward, say a week from now, where everyone stops talking about NVIDIA for a little while, that buyback really becomes hard to battle. And that's going to be a bid underlying this whole thing, which should buoy any sort of like collapse or calamity, especially in in a liquid summer tape into fall. We'll see that.
Yeah, I definitely agree with that. What do you guys think that means for this story of growth to value? We've seen continued rotation. That's been a theme of a lot of this summer into different sectors after this huge lead in the AI tech trade. But what do you guys think this spells now? Is this like the inflection point that continues and we see this, rotation into value further?
Yeah, I think we saw it in July, obviously, with the soft CPI print. And at that time, we noted on the show, actually, that it was probably a sign of what's to come. And the other signal was, NVIDIA led us, and AI led us down in the August sell-off. And we talked about when we recorded that show amidst that week that everything was kind of hitting the fan. I remember specifically saying, I don't know what's going to happen, and I don't know when the deleveraging ends, but I don't think what you want to own coming out of this is the same as what you want to own going into it. And of course, you get a bounce in a recovery. The quickest to fall in a big deleveraging usually comes back the quickest. But then after the dust settles, we're almost a month past that, and people are looking months out into the horizon and what they want to own going into Q4, into a Fed cutting cycle, into maybe what was out of the trough of the economic slowdown and into a better economic environment. And that's this value trade. And so I think, as we've seen, and it might take us through September, there will be probably chop and digestion as everybody who over the last year got acquainted with AI being the market and the economy maybe has some trepidation around these stocks no longer being the leaders that they were. And they do represent such a big concentration of the index. There is some digestion for these large cap indices to, for them to pass the baton to the value, the cyclicals, the home builders, the energy. But I think overall it's a healthier market structure when you don't have just this one large cap tech leading the way. And I think that people are looking forward to, coming out of this economic slowdown. We can call it a private sector recession or whatever you want. And I think it's time to own other things. And so this chart, Yardeni, they have so many good charts, but this is the growth to value. So you can see, dating back to the GFC, really, when the easy money policies began, quite a big leadership in the growth, the blue. And you can notice we didn't get quite to our 2021 highs in this run, but it sure feels like it's kind of topped out on there, and you want to be looking elsewhere. And whether or not this takes down the whole market, I'm of the camp that I don't think it does. I do think the Fed liquidity is going to work. I think they're gonna make sure it does. They can while inflation's low, but TBD on that front. We'll have to see.
Yeah, the market structure really is the $1 trillion question for me. But I'm seeing similar stuff to you, Quinn. Felix, go to slide 21. Mm-hmm. This is to add to Quinn's look. This is the narrowing earnings gap between market leadership. So basically, the green bars were the growth sectors of the economy. So NVIDIA was a large portion of that for the past year or so. And now earnings are picking up in X growth sectors. So you can say it's value or smaller cap things are actually, like, after 2 years of consolidation, now growing earnings again. And then if you go to the next slide, it's actually kind of shows it in a different type of graphic, but the Mag 7's contribution to the S&P 500 EPS growth started to shrink. And that is that middle blue. So as time goes on, the rest of the S&P 500 has larger EPS growth than some of these large cap mega tech stuff. So that is what I think the quants will eventually pick up, and this will be more rotational, hopefully without a massive VIX spike, another one of these giant deleveragings. But we'll see if that happens or not.
Yeah. I feel like, this is the big debate that people are having is, there's been this discussion about how the earnings growth has been super narrow, and it's just been, the mag types that have been going higher. But, the debate now is whether the baton gets passed. And I think what you see here is that baton is being passed. And I guess the discussion is, like, to what degree does that continue? And, does that show support that we're, not necessarily at the end of a business cycle, we're, maybe in the middle, and we're starting to see these other names start to take the lead in terms of upward revisions. And that's what we got to figure out, really.
If you go to the next slide too, this is IWM to QQQ, and the ratio of that dipped massively, and now IWM is outperforming. So, if you click even to the next chart, I'll give you a couple. With all this bearishness, we have the industrials ETF just broke out to new highs. Then the next chart, if you go to slide 28, XLF is actually breaking out to new highs too. So,
this is an interesting one to see at the same time that we're starting to see the yield curve start to steepen again.
Yeah, and you just had the yield curve, 2s to 10s yield curve on before that, which is normally when you see the yield curve 2s to 10s kind of steepening like this, it's breaking out from kind of a inverse head and shoulders and going positive. So the yield curve will now yield positive, which is theoretically good for banks because they're they borrow short, lend long. What's interesting about this cycle is there's not really any credit stress. So everyone's saying 2s to 10s steepening will really beat up bonds, but we haven't seen any bond outflows at all. In fact, we've seen spreads come in and yields come in. So this is kind of a fascinating divergence here. Even if we see banks almost look like they're going to keep rallying here because the yield curve is getting steeper and there's no real credit problems.
Yeah, the key thing So banks' two biggest components, if you think about profitability, you mentioned now they're profitable with a positive yield curve, and it's been a bull steepening where rates have come down, so their balance sheets have been bolstered because their long-term loans and treasury holdings have risen in value. So it's been extremely positive. I've been thinking a lot about that. Yield curve usually wreaks havoc, it's considered this recessionary signal because it's called recessions, whatever,
Yes.
10 times out of 8 or whatever. It's that stat. But when you look around, it's like, all right, why should it cause market issues? And is inflation here? Is it bear steepening where the long end is losing control? No, inflation, I think, is probably bottomed with Fed cuts and Powell's pivot. But is it out of control yet? No, that remains to be seen. The other one is, are we going in a recession? Again, with fiscal spending, I think that's what this all boils down to. Is I think I'm becoming more convinced we're coming out of the worst for this year, at least, of the economic slowdown, where we had kind of liquidity issues in Q2. We had the business cycle coming down, and now Powell's laying the hammer on liquidity. Remains to be seen if it's enough for this to be just the start of a whole new business cycle, or if this is just the start of another 6 month small reignition that eventually rolls over. That stuff's unknown, but I agree with you, Tyler, that this yield curve signal at this moment, it does not strike me as being game over for the markets. That's why I don't think this growth to value rotation, because the last time this big growth to value rotation occurred was November 2021, which obviously, if you recall, that would have been a really opportune time to sell your crypto and your long duration tech stocks. But we had inflation roaring out of control at that point, and the Fed
is a great point.
The actions are the opposite. The Fed now is stepping on the gas, and then the Fed was late. Now they're late to step on the gas, but then they were late to step on the brakes.
Yeah.
And you had this whole unwind. So I think assets are fine, and there might be some turbulence with the election uncertainty, unrealized capital gains tax, huge fiscal deficits from both sides, no sitting president. There's plenty of reasons to be risk off. But I think it'll be okay.
This is slide 26. One more chart, Neville. This is
a good one.
A really good one.
Yeah.
This is from JP Morgan this morning. If you look at the first column, and this is, I'll make it look pretty after this, but high yield is currently, this is spreads on different sectors of the bond market. High yield's currently at 363 basis points of spread. Your average recession, this is the second circle, is your average recession high yield is yielding, the spread on high yield is 971 basis points. So we're way, way, way below your average recession. And until I see the spreads blow out, I think this liquidity cycle is still here. People want us to be so bullish on crypto, which there's other stuff going on there that is not reflecting this liquidity cycle, like industrials, financials, consumer staples are absolutely ripping. So this is why all these liquidity things that we're talking about are really macro. We think they'll eventually get into the crypto eventually, but I think crypto is becoming very, very political here. But here's high yield. If you go to the next chart, the spreads, you can kind of see these. And I wanted to put these two things in because, you see these spreads blow out to the upside, and that's usually when there's recessions. And the red line is a private high yield company, a private company that can issue a high yield bonds. And the blue one is public market high yield bonds. And look at that. It doesn't signal any sort of recession or anything going on. And that's, what's fascinating to me is there's these, they call it the two-speed economy or two-tier economy. There's really pockets of the lower income consumer that are doing horrible. Like if you listen to Dollar General's conference call, we'll talk about that later, but things are really bad for like the lower end consumer. But if you look at the signals in the bond market, they are saying liquidity cycles actually starting all over again. and it's probably different companies. So
yeah, I think this is so key. Like if I was going to think about if I could just bring one, metric with me onto an island to understand like where we're at in terms of credit and whether in a recession or not, it's these credit spreads. And just going back to this one, I posted a chart the other day just comparing high yield spreads to the unemployment rate and showing how, if we're going to see continuation in the unemployment rate, you need to see these credit spreads widening out. And that happens before. Like unemployment rate is like the most lagging economic indicators. It's by the time it peaks out, the recession is already over. But I posted that chart and it was really interesting. Somebody replied who does some, I forget his name, he does some macro research, but he had a good slide from Goldman showing how they did a regression of like causal links between credit spreads and the unemployment rate. And he noted that the main like statistically significant causal link was actually in like triple C's. And even there, like you can, when I look back at that after that research that he sent me, you can see like triple C's start to rise significantly before the major upswing in the unemployment rate. Like credit spreads are real time. It's really important to be looking at like coincident data, even like leading data. But the lagging data should be at the very end of your analysis to understand like where are we finishing this cycle. So I think this is so key.
Yeah. So look at that. Triple C is 899 basis points currently, and your average U.S. recession is 1,977 basis points. So 19.77% is where triple C's are in your average U.S. recession. The non-recession triple C's are at 964 basis points. So we're even below, non-recession averages on the triple C. So take it for what it is.
And this is real market data. Like there's been this ongoing talk about these economic prints and how real they are. We had like that major NFP revision that came out. There's been this talk of revisions. What is true or not? Where is the actual signal? What's going on in the unemployment rate? Look, I mean, yes, they're all, you want to call it manipulated, you want to call it noisy, you want to call it whatever it is. But, you boil it down to market data. The smartest guys in the room are trading credit, not equities. So I'm going to lean with the credit spreads indications. And what they're saying here right now is that things are relatively okay. Now the discussion leads to, okay, what's priced in terms of rate cuts versus like what's going to actually happen to the economy that we're talking about. And this is just showing the expected change to the federal funds rate. And this is where the discussion lies. Like if we're going to just kind of slow down, then slowly rebound higher, like we might have a few too many rate cuts priced here. If we're going into a significant recession, I would argue you don't have enough rate cuts priced in here. So that's where the discussion is now, and that's what we're all trying to figure out. Just to tie it into some more of these economic, noisy data prints that we've been getting, I just want to talk a little bit about this GDP print that we got today. So it got revised higher to 3% versus the forecasted 2.8%. And the big reason behind this was a major upside surprise in the personal consumption expenditure. That came in at 2.9%, and the forecast was like 2.3. So a huge upswing surprise, and what I feel like is the most important component of GDP to look at for understanding where we're at. And just to tie it into one more slide here is I went ahead and looked at, okay, let's see where is the changes in the contribution of the percentage change of consumption, and what does that relate to in terms of change in the unemployment rate. And if you're somebody who's betting that it's the summer of 2007 and the unemployment rate's about to explode higher, these sort of huge upside surprises in consumption is like not what you want to be seeing. We should be seeing the opposite. We should be seeing this almost going negative in terms of percentage change. So I just want to put that out there is like, as we start to figure out the calculus, this is a pretty clear signal to me of, things being somewhat okay. What do you guys think?
I'll throw my 2 cents in here just on the consumer. I think things are generally okay, but speaking of Dollar General reported, and this is from their conference call, it says the majority of them, consumers, which are on the lower tier consumers, state that they feel worse off financially than they were 6 months ago, as higher prices, softer employment levels, and increased borrowing costs have negatively impacted lower income consumer incentive. As a result, our core consumer contributes approximately 60% of our overall sales, comes predominantly from households earning less than $35,000 annually. inflation continued to negatively impact these households, with more than 60% claiming that they have had to sacrifice on purchasing basic necessities due to the higher cost of those items. In addition to paying more for expenses such as rent, utility, and healthcare, more of our customers report that they are now resorting to using credit cards for basic household needs, and approximately 30% have at least one credit card that has reached its limit. In an RWA survey, 25% of our customers survey noted they anticipate missing a bill payment in the next 6 months. So this is where the credit card delinquencies are coming from. The lower tier consumer is completely tapped out because of the inflation in household goods.
Here's a chart of that like delinquency rate, and it is increasing for sure. It's not like 2008 levels, but it's for sure like that lower income class is what's being squeezed right now.
Yeah, and I think that's really the reason why the Fed is lowering rates here is you have a part of the economy is really struggling, and that is really hard for the lower. If you can't pay your credit card bills, for people revolt, and what's fascinating is the administration is the ones who created all the inflation are kind of gaslighting those very people. So
that's the problem here is the fiscal deficits. We're seeing the repercussions of this for the first time because the Fed, which I actually think they still haven't had to choose between fighting inflation and fighting unemployment, that will come. And what we're seeing is the result of governments spending way, way, way beyond their means, running huge fiscal deficits, having to issue more debt to finance that, and then manipulating the treasury yield market to be able to issue that debt in a responsible way that doesn't blow up markets. But what that does is it suppresses the bond yields, but it shoves more of that paper down investors' throats than what the market actually wants and at a price it actually wants. And to fix it, the Fed tried hiking the front end, which is what small businesses and individual credit cards, et cetera, are linked to. And it outsizedly hurt the private and productive sectors. And so we're in this situation where we can't have a recession as long as the Fed and Treasury is coming to the rescue with these deficits where they're at. But the result is they're going to cut rates when inflation's not getting below 3%. And so it's sowing the seeds for the second wave of inflation that is most likely to come probably next year. And then that's when they'll really have a decision to be made. Unemployment's at 4.5, maybe it's up to 5, and inflation starts rearing back above 4. And then it's like, okay.
Yeah, that Dollar General thing was, I saw that, and I'll be transparent. I have not looked into the financials at all of Dollar General or, Walmart. So I wanted to just like put the two on a chart here and just see this is Walmart and Dollar General. And like, how much do you guys think that, it's just shitty companies blaming things on macroeconomic reasons? Because when I think about people that are also price sensitive, like, that's Walmart too. That's Walmart's customer, and they're killing it. They're doing really great. Versus Dollar General is saying, oh, we're worried about the consumer because of X and Y macroeconomic reasons. And like, do you guys think they're also just, there's these bad companies that just aren't well managed that are blaming things on the Fed?
I think this is the two-tier economy where like it's probably true on both ends. Like for me specifically, I got 3 kids now. So I go to Costco all the time. And, I hate a lot of the globalization. Like I got to say this, like, for all the crap I talk about globalized markets, Costco is one of the most incredible places to shop. And like, it is an American dream in so many ways. And I think that's, instead of shopping at like your higher end consumer, Whole Foods or whatever, people are going to Walmart, Costco. That's like the middle class or upper middle class goes to, those types of spots instead. So I think that's probably what's happening. But, they're talking about consumers with $35,000 annually. That's like the real lower tier, consumer. And that's really hurting like a lot. So, I feel for it. It's terrible.
You could probably do CVS and Walgreens on that chart too, which shows Walgreens has just been crapping the bed. I don't know too much about these individual names, but
Yeah.
you're probably right to some degree, Felix.
Hey everyone, this episode is sponsored by Polkadot. Out of the 500 protocols, one of them is called Origin Trail, and they're building a verifiable internet for AI, ensuring the provenance and verifiability of data to tackle challenges like bias and misinformation in AI systems. Used by global leaders like the British Standards Institution and the Swiss Federal Railways, Origin Trail is vital in sectors like asset tokenization, healthcare, and the metaverse. Powered by Polkadot, Origin Trail enhances the discoverability of crucial knowledge and secures information in the AI era. Power the verifiable internet with Origin Trail at origintrail.io. This episode is sponsored by Mantra. The Mantra chain, built with the Cosmos SDK, is the blockchain of choice for regulated digital assets, offering compliance-ready modules and cross-chain interoperability. With partnerships like a $500 million tokenization project with the MAG Group, in collaboration with Zanbank in the United Arab Emirates, Mantra is at the forefront of the RWA revolution. Scalable with up to 10,000 transactions per second and secured by a sovereign proof-of-stake validator set, Mantra is designed for both permissionless and regulated applications, making it easier for institutions to enter Web3. Discover more about Mantra's capabilities and how you can participate at mantrachain.io. All right, back to the show. Yeah, I don't know. We're not stock pickers here, so this is somebody else's game. What we are, though, is macro nerds, and I nerded out pretty hard this week on some Fed papers that have been coming out.
Great transition. Great transition.
Thank you. I try. I've been working on those. No, but this report came from the Kansas City Fed this week, and it just starts to give an interesting glimpse into how the Fed is beginning to think about the future of their balance sheet. The big takeaway here is there's, how often monetary policy starts to transpire is you get the big fancy think tank PhD economists that come out with papers like this that just kind of float ideas, and then eventually they talk about and share those ideas, and then maybe eventually it turns into some sort of monetary policy implementation. So right now we're in the fancy paper stage, and we got this one called Considerations for the Longer Run Maturity Composition of the Federal Reserve's Treasury Portfolio. And there's a few interesting things in here, but really what it shows is just what's been going on pre-2008 and post-2008, or pre-QE and post-QE. So pre-QE, the weighted average maturity of the SOMA portfolio, which is just a fancy way of saying the Fed balance sheet, the maturity composition used to be much, much shorter. They used to be mostly T-bills, because the main way that they would manage the federal funds rate band is basically through reserve requirements, basically. So they would have and basically warehouse inventory those T-bills and sort of manage reserve levels to basically manage the federal funds rate band. After 2008, we obviously had QE, and they started buying long duration debt, mortgage-backed securities and treasuries and that sort of thing. And so that's what you can see in this chart here. And Operation Twist, which happened in 2013, is where they effectively says here, selling short-term securities and using the proceeds to buy longer-term securities. If that sounds similar, it's actually exactly similar to what the Treasury is doing right now, Treasury buybacks, issuing short and borrowing long, in a way. So they did a lot of that, and that basically brought the weighted maturity higher, and we've seen continuation of that with QE over the years. So this has been really interesting to me is, there's been a lot of talk about the impact of QE on the long end of the bond market, of the yield curve, and just, risk assets as a whole. And what's really interesting about this chart is it comes from the Fed. It comes from the Kansas City Fed with data from the New York Fed. So this is it's just interesting to get it direct from the source of how these monetary policy people are thinking about things. And the way they think about it is due to all of this QE over the last, since 2008, and this shift to a longer maturity, they've basically suppressed the 10-year Treasury yield by more than 1% as of 2024 Q2. So when people talk, I interviewed Michael Howell this week, and he talked a lot about how the long end of the yield curve is artificially low. There's been people like George Robertson who've talked about it too. A lot of people are starting to notice this, and this is just really interesting to see how they're thinking about it, and then how they're starting to think about the next future here. And what they're advocating for is basically trying to get back down to that shorter duration of maturities, closer to T-bill composition. There's a few different reasons why. I'll link this paper in the show notes so you can read it if you want. But really, it's about creating space that if they do need to do QE, they can easily do it. making sure that with a shorter duration portfolio, they won't have those big, operating losses that we've been seeing. There's been some charts of that, just like huge net losses due to their balance sheet of long duration debt, keeping it market neutral, and what they call safe asset provision. So a lot of academic talk in here, but really what it boils down to is they're starting to think about moving towards being more of that shorter duration SOMA portfolio and away from the long end. And that, to me, as a market participant, I start to think about, okay, well, that means there's going to be a lower marginal buyer of long end debt at a time where foreigners and other individuals are pulling out. And if we're seeing them like not cyclically moving back to this, but like secularly, who the hell's going to buy all this debt?
Yeah.
It's funny that this is coming up now, because they're like, on the one hand, it's such a two-faced topic. On the one hand, the Fed is cutting rates into 3% inflation, and on the other hand, they're like, oh, maybe we should unwind our portfolio. And it's basically the reverse of, Barry Knapp has been the most vocal on this. Shout out to him. He's a killer, former Guggenheim alumni as well. But he's been talking about how the Fed did aggressive QE with their balance sheet and rate cuts, but then passive QT with balance sheet unwind and aggressive rate hikes. And that just totally messed everything up and really is the cause of the mistakes that we're seeing play out. And now we're at a time where the economy is slowing. So the time they should have been unwinding the balance sheet was when things were strong post-COVID. And now we're heading into the worst possible time to be talking about taking the biggest buyer of these bonds out of the market. I mean, that would absolutely tank markets. The fact that they're entertaining this is funny to me, because there's no way that they're able to do it in this, in the near future or foreseeable future, in my opinion.
Yeah, my read is, I don't know, I think about all these academic things more in my third grade brain as they're figuring out how the software works of monetary policy better as time goes on. And back in the 30s, like 1930s, they had no idea they were tightening into recessions. And now we've figured it out a lot more
Totally.
Of how the system works. But at the same time, it's way shorter term incentives that you're just playing whack-a-mole. And every time you play whack-a-mole and you're this, I call them vol controllers, I've said that ad nauseum, you're really just trying to control volatility in the market. But in that, what you end up doing is you create imbalances in the social contract. And that's what these nerds don't friggin' understand, is you end up really messing with society over long periods of time. We've seen 15 years of this, and I think we're starting to have a fever pitch. That's why the politics are getting kind of nutty. And we're seeing the people can have two different realities now in America. And that's why, I thought the RFK speech was just really uniting. And I think most people actually want that.
Yeah.
But the more you try to control monetary policy in markets, it really is, it's kind of, you have all these side effects. So I don't know. I think, it's good they're paying attention to this, because no one wants a crisis, but you can't just keep pumping steroids in the market and not expect things to break.
Yeah. The other side of the issue is that they've done that so many times, it's hard to come out of it now too.
Yeah. Now you're all jacked up on steroids and come down, you got these mood swings.
I literally go back and forth on who's to blame, the Fed, or, can you blame individuals like Powell or Yellen? Or is it just, well, that's what you would do in the situation too, to bolster markets. You don't want to be the person that causes this huge recession. But I think one area you can have beef with, and just thinking in recent memory with Powell, is consistently is asked about the fiscal deficit spending problems and consistently says that's not my area.
Yeah.
And okay, cool. If you were actually an independent central bank, then that's an okay thing to say. But the second anything goes awry, that you have breakfast weekly with Janet Yellen, who's the Treasury Secretary, this facade of independence is no one believes it. And the credibility is being very, very damaged across global developed market central banks by acting as if you're independent. Look at what happened in the UK LDI crisis. Look at what happened just recently in the BOJ, where they walking it back. There's no independence in these central banks. Actually, the emerging market central banks are more independent from their governments and more fiscally responsible in their politics because they've experienced these inflation and currency crises. And ultimately, it's funny, but I think down the road, you'll see almost a passing the baton from growth to value and, US to rest of the world. There's so many downstream implications of this. And the dollar's showing you right now. I mean, right now we had a flight to safety in a bid for bonds while the dollar weakened. And in the future, a really bad scenario is the dollar weakening and economy's going to recession, but not getting that flight to US bond bid because people know the answer to that recession is blowing stimulus and liquidity out even worse. And no one wants to hold that. So that's that's probably the next one. I don't know, 1-2 years away or something.
What's up, everybody? Just want to take a second out of the show to talk about the next major Blockworks conference that's happening. Permissionless 3 is a leading crypto conference, and it's going to be happening in Salt Lake City this year from October 9th to 11th. There's going to be some major legendary speakers there from the likes of Balaji, Chris Dixon, and macro veterans like Dan Teffiaro will also be there. Not only that, but we're also going to be doing a live recording of the weekly Roundup on the Margin Guys Emporium edition. So you can come meet myself and Tyler and Quinn and even Mike will be there. If you're interested, we have a discount code, Margin10. Use that and you'll get 10% off as well. So I hope to see you there and that we can catch up. All right, back to the show.
Could the dollar falling have just been someone flew over to China and said, hey, we'll weaken the dollar. And Jake Sullivan's there right now meeting with Xi and said, we'll weaken the dollar if you buy our treasuries again.
That's what Michael Howell thinks. When I talked to him this week, he thinks there's like a Shanghai Accord 2.0 that's been going on.
Yeah, and it makes the most sense where, if you want to have a salubrious environment heading into the election, you make concessions with one of your biggest counterparty in the world. So,
but the reason for this dollar weakness is the Fed finally cutting after a long time and basically doing it while inflation's still 3%. So I think this dollar weakness is by their own doing. I think China and most of these emerging market central banks have acted responsibly. They haven't flooded the market with, helicopter money and stimulus, and their economy is taking great pain because of it. Right, their bond market has been the best performing in the world, and the yuan acted as a flight to safety when the yen sold off, the yen strengthened things. So I think it's hard to wrap your head around it because you're always taught emerging markets carry more risk, and the irresponsibility of these fiscal decisions is worse in those countries. But it's actually becoming quite opposite, and the large capital allocators haven't come onto it yet. But it will happen, and NVIDIA is a beneficiary of that will not be in those situations, for example.
Yeah, the core of that is just what happens when you get, drunk and greedy off having the reserve currency is all these other EMs are, anchored by the fact that somebody can just start selling their bonds and they can have a debt crisis on their hands, but that can't really happen in the US. So they get a bit more excited and a bit more, trigger happy with their printing versus these other countries.
You know what? One thing I wanted to bring up too. This is slide 20. And I thought this was really interesting just from a global geopolitical standpoint. But D.E. Shaw sold 12 million shares of NVIDIA, trimming his position by 52% while he bought 2.4 million shares of the Bitcoin Trust. And Steve Cohen did the same thing, trimmed his position by only 16% in NVIDIA, but bought 1.6 million shares of IVIT. Now, this isn't to me, I think we're watching this battle we're talking about centralization in central banks and global central banks centralization. And the beneficiaries of all that were the large cap tech companies. It's clear that centralization really helped the fastest growing horses, the fast horses. And why are these guys rotating their portfolios into Bitcoin now? Is my question.
Yeah, it's been interesting to see who owns it. Like, initially it was it looked like high frequency market neutral funds were buying the IBIT ETF to do like carry trades and that sort of thing.
Mm-hmm.
But it's, you're starting to see these big macro thematic people start to show up. Steve Cohen, Paul Tudor Jones, they're starting to bid, not in huge size, but they're showing up. And I think that's a signal for sure.
Yeah. And I think this is all tied together in global monetary policy. Is like, there's clearly Bitcoin is the center, ground zero for kind of a lot of geopolitical things too. We're seeing Bitcoin sell off drastically on Israel and Binance and all these weird headlines. It's becoming like, and Trump comes out today and he says, he's going to make the U.S. the crypto capital of the world, and has a whole plan that he's supposedly announcing later today. So I don't know. I think these things are all tied together in one way or another, and central banks are at their wits' end. Like you're citing these papers they're doing about whacking 10-year treasury yields just in case they spike a little bit. Like that's a sign of weakness. That's not a sign of strength.
I mean, I think that's a good tie to crypto, is that like everything we've talked about, it's so obvious, and yet the damn thing just is, making everybody pull their hair out. I posted these couple charts today, just looking at like the gold price action, and I'm not a big technical analysis guy, but man, when it just hits you in the head, you just got to appreciate it for a minute. And it's just, as somebody who's been in and out of the gold trade over, not the entire story of this cup and handle, but through a lot of those, at least the last 3 fake outs, to see it actually happen now and break out meaningfully higher. And you pair that with the sentiment you see around gold right now, there's not that much froth. There's some for sure, but for where we're at, everybody's still looking at NVIDIA while gold sets new all-time highs today. And then, I posted that gold chart and somebody was just mentioning about how much the weekly, the gold chart's on the monthly time frame, but the Bitcoin one's on a weekly one. So, just like a slightly shorter length one, but man, it's very similar. It's going through this potential bull flag that is just driving everybody insane throughout the summer. Quite similar to last year. And everything's lining up for it, but there's just the big buyers aren't really showing up. And we're just, getting bounced around from liquidation cascade to short covering liquidation cascade. And we just kind of bounce between, 66,000 and 50,000. And it's just driving everybody insane. But I don't know. Why aren't we pumping, guys? What's going on?
Hopefully this is the last time I say the word NVIDIA for a very long time. But actually, I think it's healthy for crypto. People have short memories, but not too long ago, say June timeframe, people were pulling their hair out. Why NVIDIA's going to the moon and crypto's just, that can't do anything. And in fact, what happened was the ETFs pulled forward a lot of demand probably, and corrections can occur through price and time. This hasn't been your typical minus 40 vicious, down back up correction. It's been more of a time digestion. And what's been occurring is retail. Go talk to your friend that works in finance or, occasionally leisurely trades investments or, in their brokerage accounts. They're focused on AI and NVIDIA, and that has captured retail attention. It hasn't been crypto like it was in 2021. And so I mentioned that letting the air out of that trend might be bumpy for the broader markets as the baton is passed. Could be the same for crypto and Bitcoin. It's actually quite healthy. And I think that, in the same way that, we're getting this different regime of monetary policy, Fed cutting while inflation is still sticky, that's where you want your digital gold and not your, long tail, large cap tech stock. So I think, these things, you don't want to read too much into I think one of the Monday or Tuesday of this week was the lightest trading volume in traditional equities of the year or something so far. So this is a time where you can literally see in the leverage and trading volume data where it's just big whales opening $1 billion long, closing $1 billion short, just in super illiquid times. And I would say that there's probably not a lot of true signal, and in this price action that's happening in these late summer weeks probably holds through next week. The people that would normally be buying the ETFs, the institutional allocators, they're on vacation these weeks. So I think you just have to be patient, and these things have a tendency to just absolutely fluster everybody to their last straw, till even the most resolute people throw in the towel. And then, some unforeseen thing happens, maybe it's around the election, maybe it's around, 50 bips in September instead of 25. You get this God candle and everyone wakes up and is like, oh shoot, that's what I spend every day in this industry. So you just gotta be patient and, not be like 10x lever long on each little wick. And I think you're okay.
I have to go political here as the reason why it's not breaking out. You have your leading candidate for president, Nate Silver, just came out and said Trump is leading. I think it's 54-48 in his latest poll. I believe it's somewhere along that. And it's basically September and the elections in November. Wouldn't you think if this guy is going to do a strategic Bitcoin reserve and he's leading in the polls, that if you're any other country and you're like, holy crap, he might buy a Bitcoin reserve. We'll find out what his plan is tonight. But he and RFK are both Bitcoin bulls. That should be discounted a little bit. But there's a lot of funky trading going on. And there's geopolitical ramifications if he actually does this. So I'm sure there's,
hidden big sellers for sure.
Hidden forces trying to keep it down. That are, I think that's why it hasn't really broken.
And if people think that's conspiracy theory, JP Morgan got litigated for doing the exact same thing for gold and silver. So it's not that far-fetched.
Yeah. I mean, you kind of expect it. I mean, this thing could destabilize a lot of generational power structures. If Bitcoin becomes a strategic reserve, think about petrodollar recycling. That was the backbone of the entire economy for 40 years. And now, those power dynamics are breaking with the U.S. being one of the largest oil supplier. Anyway, the point is that if he makes this a strategic geopolitical asset, which is 2 months away and you're leading, you'd think this thing would discount it, but it hasn't. So what is it telling us? It's either telling us there's a giant holder that does not want that to happen, or a country, or whatever it is. But I would imagine other countries would start buying this ahead of it, just as a strategic reserve. Wouldn't you assume that would happen? Or pensions? Why would you wait until it actually happens? You have to act on the imperfect data, but no one's doing it. So it's kind of fascinating.
Yeah. I mean, it's so hard. And, to Quint's point, the return distribution of Bitcoin and crypto is so clustered. You literally you get driven insane through chop like this. And then it all just comes in a couple God candles. And then that activates the momentum loop and people just pile in, and it's incredibly reflexive. And when these things happen, your job is just to not chop yourself up, not liquidate yourself, and not drive yourself insane. I had to share this chart. This is just insane to me. So what we're looking at here is the trader's net P&L of hyperliquid decentralized perpetual exchange. So basically on-chain DEX traders that are leveraged futures. And basically, because it's all on-chain, you can kind of see what the net P&L is of traders. And nobody's winning. Everybody is just getting decimated. So 2 lessons here. One, if don't trade perps, or if you are, just incredibly low leverage. And 2, don't do that during the summer when it's clear how heavy this thing is trading, because just look at the damage we've seen over the last few months. No one's making money.
Yeah. That's really good.
I think that's what I would say too, is don't underestimate the tendencies of the market participants here. You see people closing $50 million Bitcoin market orders into an extremely midnight illiquid tape. I mean, there's just some real unsophistication of the actors, and and you can get some big price movements. And remember, it's a momentum asset, and that works in both directions. Like what we wicked to 74K in March on the ETF momentum, and we never even came close to that again. And, let's say if it was a less FOMO momentum asset, maybe it would have peaked at 70 or something. It happens at the downside too, right? Where so many people trade this asset not based on its macro flows that I would say we're the outliers in that regard. And so you have to assume there's a little bit of a, come to Jesus, delay in the market's reaction. And it usually occurs in both directions. So I actually see it as an opportunity where, if you're not leveraged crazily, you can withstand this and be around for those really good, strong clusters.
Do you guys know, there's a question, how much Bitcoin is being sold from Japan? Because the only logical thing to me outside of the geopolitics is the dollar crumble and the yen rally. And if Japanese investors are selling their Bitcoin to essentially cover their shorts in yen, or maybe they're selling Bitcoin to reinvest it or repatriate it back into the Japanese economy to stay ahead of the inflation or potential inflation with the yen crumbling. Are there any dynamics showing that, or have you heard anything? Because that's one that I don't watch closely.
No, I haven't, but it would add up.
Yeah. That's the only thing geopolitically that would make sense as to why dollar gets crumbled and normally gold takes off, and relatively if you have holders of yen that were levered to Bitcoin that could cause this, but it's been going on for a lot longer than I thought it was.
I want to wrap up as well. We got our Q&As for the week here, so I added a few in here. The big one I want to just quickly chat about is, will rate cuts in September be a sell the news event? This is something I've been harping on a lot about endlessly, is this gets at the thesis and the discussion of, are rate cuts bearish or not? And it is incredibly dependent on the context. You can't just look at changes in interest rate and Fed funds as the causal factor to market events and recessions. I see people say, oh, the Fed lowers rates and it causes a recession. That is just not how this works. It's just insane to me. You got to look at the context of how many rate cuts are priced in right now, and what does that reflect? And that will lead to the theme of that first rate cut. So right now, I would say, on my personal opinion of where we go in the economy, we're a bit rich in terms of the amount of rate cuts priced, but not crazily so. I think 50 basis points is a stretch. I think 25 basis points is likely. As long as these aren't recessionary style, rate cuts or panic induced ones where, oh my God, the economy is truly rolling over, we need to cut as quick as we can. That's just happening coincidentally as the economy rolls over and markets roll over. And then it just takes time for the Fed reaction function to catch up to that. So that's why you see those crashes happen. What we're seeing right now is not that. It's a growth slowdown, and it's a move from restrictive to less restrictive. So a normalization cut in terms of their monetary tightness. That to me is generally a bullish thing. I don't know how many people have that in their base case. I still see a lot of people thinking that it's going to be bearish and thinking they're going to be recessionary. So it makes me feel like it's going to. What's that?
I love hearing the bear case, because it's that's
exactly
what happens. That's typically what happens. And usually, the past, they printed $12 trillion between infrastructure plan, monetary, in that time where lowering rates, when they lowered rates previously, there was a credit crisis happening because there was part of the economy falling apart. And now, between now and then, they've spent 15 years of printing money. So now you lower rates and maybe it just affects a different sector of the economy, and part of things are partly delevered. The only thing that's not delevered is the actual Fed balance sheet and global balance sheets. That's the problem. And it's not the corporates anymore.
You guys each want to take one, and then we'll wrap up here.
Which one? You give me one, Felix.
Talk about if we'll ever see real rates again negative.
Oh, that's a good one.
Yes.
And here's what we're talking. I actually have a chart here ready for it, but this shows 10-year real rates. So what he's asking about is, will we go negative like we just seen here in 2012 and a few years ago.
Can I take that one?
That's tough. Yeah, go for it.
Go for it, Tyler.
Hell yeah, we're going to see negative real rates again. You have to delever the economy somehow. I mean, we have this huge deficit. You need growth. Like, you need to manufacture growth. And think about all the boomer stuff we have to pay for. You know, all these boomers are going to get old, and they have so many things they've promised themselves that we are going to print to oblivion. Maybe it's 10 years from now, but we'll definitely see negative real rates for a long period of time. And that's like, you get the post-truth world thing going on again. Like, you could stay in that for a while. And when we get into office, millennials and Gen Zers, there's no doubt we're going to pump that thing. They're going to be like, and that's really, it's scary to say that, because then you really get social contract breaking. But there's a way you can do it that's smarter. But yes, I think there's no doubt we'll have negative real yields again. Yeah. Absolutely no doubt.
I agree, and I think we'll see ZERP again. And it's funny that's even crazy to say. Like, some people think I'm an idiot for saying that, but I do think we'll see 0% again.
Yeah,
I don't have very strong feelings towards those things, because the cat's out of the bag. ZERP works when inflation's zero, and inflation is not going back down to zero. So I kind of think that I think you can have huge government intervention akin to like maybe the levels we've had previously. But I don't think that necessarily means negative real rates here. Because if inflation is at 4%, 3% or something, like, you know, I don't know.
I think we have a way bigger chance of getting into like a Weimar Germany type money printing scenario than people think. And the geopolitics are so fragile. That's why I'm like, negative real yields are possible, and we might dig up half of the Permian. We'll dig up the Permian. We'll dig up Alaska to try and like keep the inflation at bay. But I think that's sadly our future, unless we do some nuclear stuff too, which Trump's talking about.
Quinn, maybe you can wrap us up by just talking a bit about how you think about altcoins from a macro context. Spencer was asking a bit about, what does that look like versus Bitcoin in a declining real rate world? But as like a macro thinker that trades alts, how do you think about the alt market?
I've been thinking about this more. I think the ETH lackluster performance, the ETH ETF lackluster performance is a pretty detrimental sign to the rest of the alt universe. I mean, obviously it's very diverse. There's thousands of tokens. There's hundreds of projects. I mean, you got to do your own research, and idiosyncratically, some can outperform, in different times without the macro working. But at a macro level, I think Bitcoin dominance continues to rise in terms of like ETH BTC and let's say like Sol BTC-ish ratios, or maybe less so Sol BTC, because I think there's still some of the catch-up trade. But let's just say ETH BTC is the alt barometer. If you look at ETH ETF flows, their volumes, they're like 10, maybe 20 at best percentage of Bitcoin. And if you believe, as I do, that the largest marginal inflow of capital and buyer of crypto this year, so I assume that's going to go forward, is the ETF provider, the ETF buyers of Bitcoin, you would think that ratio converges on their preference of ETH BTC to the flows and volumes. And right now, ETH BTC is like 25% of ETH is 25% of Bitcoin's market cap, and the ETF flows volumes are like 10 to 20. So that suggests a decent ways down in that ratio to go. And I think the ETH hate is counterproductive as well for the rest of the alt eco, because I think it limits, Solana's upside from a valuation perspective. I think it kind of shines a light on the rest of the alt universe still having valuation issues. Like, I don't look at the ETH BTC ratio and say ETH's doomed, ETH as a product sucks, it's totally messed up. I look at it and just say, well, there's ETF, and all the smart money says they don't want it at this price. There's a price they will want ETH, and it's just not here relative to Bitcoin. If ETH BTC goes to 0.03, I have a feeling they're probably going to become buyers there. But at 0.05, 0.045, probably at 0.04, they don't think that valuation stands up. And, you look at Bitcoin, there's a clear path. It's 1/15 of gold's market cap. It makes sense. you could see a 2 to 3x pretty easily from there without any gold market cap appreciation. And you look at ETH and it's not money, so you kind of have to price it like cash flow, or it's usage like a commodity. Demand flows, and at its current market cap, people don't want it. So I don't take these like draconian views that it's like a doomed asset or whatever. I just think that the price is not right. And for most alts, that is also the case, because if ETH BTC is 0.03, what's that imply for all your other alts that are priced off ETH activity and those cash flows? So that's how I think about it.
What are you, an investor or something? I need a bigger, more extreme statement. Give me some extreme statements.
Yeah. I need a buy price, a sell price, and a take profit price, and a stop loss price. So if you just hand that over, that'd be great.
We're going to the moon.
Yeah.
Yeah. I'll give you one time. I think ETH BTC 0.033 by the end of the year.
Really? Okay, hold on. Yeah. We can cut out.
You want to take a bet? Since I already beat you on the coin BTC bet back in March. Double or nothing.
Well, I gotta look at it. But
all right.
Likely, potential. Yeah. I could see it. Real, test that point and then reverse. All right, guys. That was a great show. Great to catch up. Great to chat.
Good stuff.
Have a good weekend.
Right.
There's over 500 protocols building on Polkadot, and one of them is called Polymech. Polymech is a decentralized, community-driven funding protocol on Polkadot, enabling regulatory compliant and transparent fundraising of Web3. Polymech ensures compliance with a novel KYC AML process, facilitating a trustless and automated funding process from fundraising to token distribution. By removing intermediaries, Polymech offers accessible, inclusive, and transparent funding opportunities for all participants. Powered by Polkadot, Polymech is redefining fundraising in the crypto space. Explore how to become a Polkadot VC at polymech.org.